Hey everyone, welcome back to Corporate Dakota, the place where we dive deep into company filings so you do not have to. Today we are sifting through Alliance Resource Partners LP's latest quarterly report. Get ready for some big numbers and even bigger implications. Before we jump in, if you love getting the real story behind corporate finances without the jargon, make sure you hit that subscribe button, and for those wanting to connect with other finance enthusiasts, our Discord community is linked right below, so come hang out. Alright, so this is a quarterly report from Alliance Resource Partners LP for the period ending the 30th of September 2025. Think of it as a quick checkup on the company's health. Let us start with a quick look at what the company owns. On the asset side, they have cash and cash equivalents totaling over $94 million as of September 2025. That is down from over $136 million at the end of last year, which is something to keep an eye on. Their inventories are a bit higher, around $130 million. That is not unusual, but it means they have a lot of stuff waiting to be sold. Now, looking at the other side of the balance sheet, they have total liabilities of over $1 billion on the partner's capital side, which is essentially the owner's stake. It is around $1.8 billion. So overall, the company has more in owner equity than debts, which is good. Now, the fun part, the income statement for the 3 months ending September 2025, total revenues were just over $571 million. That is down from about $613 million in the same period last year. It is a drop of around 4%. Think of it like losing about 1 in every 20 customers or sales from that period. The main driver here seems to be coal sales. They dropped to over $511 million from over $532 million last year. That is a decrease of about 4%. They sold more coal, which is interesting, but the price they got for it dropped. That is like selling more apples, but getting paid less for each one. Their oil and gas royalties also saw a slight decrease. This tells us the price of oil and natural gas might be a bit softer, or perhaps they did not have as many new deals coming in. On the expense side, their operating expenses, excluding things like depreciation, actually went down slightly, which is a good sign. They are managing their day-to-day costs better. However, depreciation, depletion, and amortization went up slightly, which often means they have invested in new equipment or mines. This drop in revenue coupled with somewhat stable operating costs led to a slightly lower income from operations. For the 3-month period, it was about $104 million, down from a little over $101 million last year. So, while revenue fell, their cost control helped buffer the impact. That shows some operational efficiency. Looking at the bottom line, net income attributable to ILP, which is what is left for the actual owners after everything else is paid, was about $95 million for the latest quarter. That is up from about $86 million in the same quarter last year, so despite lower revenues, they made more money for the owners. How did that happen? Well, looking closer, the income from operations itself was a bit lower. But other things like interest income and investment gains helped boost the final net income. It is a bit of a mixed picture, but the higher profit for owners is a positive. Now, about those owner earnings, the earnings per unit were about 73 cents for the latest quarter, up from 66 cents last year. That is a nice bump, showing they are generating more value per S-hair for their investors. This is often a key metric for investors to gauge profitability. Moving over to other comprehensive income, which includes things that affect equity but are not on the income statement. They had a loss in this area. This is often tied to changes in the value of certain investments or currency fluctuations. It is not directly tied to daily operations but can impact the company's overall financial health. Let us talk about cash. Cash from operations for the 9 months ending September 2025 was about $507 million. That is lower than the $634 million in the same period last year. This difference is largely due to changes in how they manage their working capital, things like how quickly they collect money from customers or pay their suppliers. In investing activities, they spent almost $251 million. This was mainly on capital expenditures, which means buying new equipment or facilities. They also made some investments in other companies through equity method investments. This shows they are putting money into the business for the future. Financing activities show how they raise and pay back money. Here, they used around $298 million, which is more than last year. This was due to paying back debt and making distributions to partners. Distributions to partners are essentially dividends to shareholders, and they paid out a significant amount of over $259 million in the latest quarter alone. That is a big chunk of change, showing a commitment to returning cash to investors. Now, let us peek at the notes to the financial statements for more context. Under assets, they list digital assets, which is pretty interesting. They hold over $64 million worth of digital assets like Bitcoin. This is a growing area for many companies, and it shows they are diversifying beyond traditional resources. They also have equity method investments totaling over $54 million. This means they invest in other companies where they have a significant influence but not full control. Their inventories show a significant reserve for obsolescence on supplies, which is around $7.3 million. This means they have identified a considerable amount of their supply inventory that might be outdated or unusable. This can indicate potential write-downs in the future and is something to watch. Looking at their long-term debt, it is around $433 million. This is a manageable amount given their assets and equity, but it is always good to monitor. They have revolving credit facilities and senior notes. The senior notes at 8.625% due in 2029, totaling $400 million, are a significant portion of their debt. The distributions to partners, which are like dividends, are a significant part of their story. They paid out over $259 million in the latest quarter. This is a direct return to unit holders, reflecting their strategy to provide income to investors. When we look at their segment performance using a measure called Segment Adjusted EBITDA, which is a way to look at operating profitability without certain expenses, we see some interesting trends. For the latest quarter, it was about $207 million, up from about $192 million last year. That is a good increase. The Illinois Basin Coal Operations segment saw its segment adjusted EBITDA decrease by about 8%, mainly due to lower coal prices, even though they sold more coal. This highlights how sensitive their business is to market prices. On the other hand, Appalachia Coal Operations saw a significant jump in segment adjusted EBITDA, up by over 44%. This segment is performing very strongly with lower operating costs and better productivity. Their oil and gas royalties segment had a slight decrease in segment adjusted EBITDA. This suggests that while their coal business is doing well in Appalachia, the oil and gas side might be facing some headwinds, perhaps lower commodity prices or slower production. The coal royalties segment saw a good increase, which is positive given that it is a royalty income stream. Now let us look at the bigger picture, the story behind these numbers. Alliance Resource Partners LP is showing resilience in its core coal business, particularly in Appalachia. They are managing expenses well, and the increase in segment adjusted EBITDA indicates strong operational performance. However, the drop in overall revenues and the dip in the Illinois Basin operations due to lower coal prices are clear warnings. They are also diversifying into digital assets like Bitcoin, which is a bold move that could pay off or add volatility. Their strategy to return cash to unit holders through distributions is a key part of their investor appeal. However, the considerable increase in cash used for financing activities and the drop in operating cash flow warrant attention. This suggests they are either investing heavily or facing some cash flow pressures. Risks are always present, and their report highlights significant ones. The decline of coal's share in electricity generation is a persistent challenge. They are also exposed to commodity price volatility in both coal and oil and gas. Their investment in Ascend Elements even led to a substantial impairment charge of $25 million, showing the risks involved in investing in newer ventures. In conclusion, Alabama Alliance Resource Partners LP is navigating a complex energy market. They demonstrate strong operational control in key areas, but market price fluctuations and the broader energy transition pose ongoing challenges. Their diversification into digital assets and new energy ventures is a strategic bet on the future, but it comes with its own set of risks as seen with the Ascend impairment. It is a company adapting, but the path ahead still has the potential for bumps. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord community linked in the description for more discussions. Thanks for watching. See you next time.